Hello, everyone. I've got David Eads here with me from Vital Investment Management to answer some questions about inflation. David holds the designation of Certified Financial Planning Professional and possesses extensive experience in tactical investment strategies, comprehensive financial planning, and tailored retirement planning. He has spent his many years in the financial industry devising unique strategies to manage client investments and personal finances effectively. Dave operates out of Northern Colorado and serves people throughout the country. So thanks for joining us today, David. I appreciate your time here.
Thanks for having me.
So let's start with the big question. What is inflation?
Inflation is the calculation of the price of a basket of different goods or services, or a combination of the two, and the increase in the value of that basket of goods. So if you're looking at food, for instance, you have food inflation or housing inflation, which would be the price of rent or price of a home, or employment inflation in terms of the expense that it costs businesses to employ their employees at the business. So that'd be labor inflation. So there's different types of inflation. There's also disinflation and deflation, which are totally different in terms of the direction. So disinflation is when you're inflating, but you're starting to go down with your inflation, which is kind of what we're trying to do right now, is slow the inflation. And then deflation is when the value or the costs of some goods and services actually go down. So typically, we here in the United States target a 2% per year inflation target, and that's set by the Federal Reserve. And the way that the Fed controls inflation is with interest rates. And by increasing interest rates and increasing the cost to borrow money, it can put a cap on or slow inflationary pressures. So that's when you hear right now that the Fed may be raising rates, that's really what they're trying to do, because we have full employment, which is the other goal of the Fed. We're effectively at full employment right now, but inflation is running red hot. So the main tool that the Fed has is to raise interest rates to slow inflationary pressures. And you probably see inflation around you as housing prices or rent goes up from where it was a year or two ago. Price of gasoline goes up, or heating your house. A lot of the goods and services that we purchase in our lives are going up, and that is inflation.
Got it. Can you give us a little bit of perspective on what our inflation, like you mentioned that our target is 2%. What are we looking at right now? And kind of how far out of the norm is that?
Well, there's a lot of different ways to measure inflation, and that's part of the issue. And even some of the ways that we measure inflation, if you're trying to be consistent, the calculation has actually changed. So you hear of CPI, the Consumer Price Index, the PPI, which is the Purchasing Price Index. That they're different measures or different calculations of inflation, and they're all geared to see what inflation is, but on different people or on different industries. And so it can be a little confusing because there's so many different types of inflation calculations. The inflation right now, so if we just take a step back and say what happened in 2021 and the inflation, because that's when we started to see inflation was coming in 2021. The US government, when they are doing increases in Social Security payments for the cost of living, which is inflation, they make these COLA adjustments, COLA, which is a cost of living adjustment. Those jumped about 6% starting this year. So the inflationary number that the US government is using for people who are retired in the United States is about 6%. Now that changes from month to month as we get different readings for different indexes, but it's really, the bottom line is it's well above 2%. It's been well above 2% for about a year now, and it's looking like it may persist for months longer, if not a year or possibly beyond that. The issue is that there's different drivers of inflation popping up at different times. And so one price may be flat or just slightly inflated, while there's significant spikes in other indicators. And that is what's making some of these inflation numbers bump higher and higher, is there's just different waves of inflation in different categories that keep pushing inflation higher. It's not just been one specific item. It's been different items at different times.
So like housing might go up and then kind of stabilize, but then groceries are going up, things like that. Is that what you're referring to?
Yeah, well, housing is a great example. So the price of houses has gone up significantly over the last 2 years and over the last year. But the calculation for a lot of housing inflation within these indexes like CPI, they're using owner equivalent rents. So that it's really a rent number that they're using, and rents trail behind housing prices. So housing prices go up first, and then the landlords increase the rents after the price goes up. And so it's a trailing indicator, and that's one of the big issues this year is likely going to be housing, as rents move higher and higher, catching up with the valuations going up. So that's a perfect example. Housing, it's going up. It hasn't really been reflected much in the numbers yet, but this year it'll reflect significantly so.
Got it. Got it. So a kind of a follow-up question to that is, did anybody expect this to happen? I mean, was this out of the blue? Was this kind of just, we figured we'd need to take our medicine when we reopened after, the big COVID restrictions of 2020 and 2021?
Well, to this magnitude, I can't recall. I'm sure someone has. We could search them out and find the person who called this, right? They've probably been saying inflation is going to go up like this for years and years and years. Of course, they'll be right eventually. But in general, there wasn't a consensus that you'd have this level of inflation for this amount of time. Initially, when we saw the spike, the big buzzword was transitory, which means it would be here just for a short period of time, and then inflation would disinflate or go back down to 2% or so. It's long-term target from the Fed. When you come out of a recession like we had in March and April of 2020, there was a lot of pent-up demand. So it wasn't a typical recession where a housing bubble burst or savings and loan crisis, anything like that. This was the government stopping people during a great economy. And so the economy came to a halt, and you couldn't just flip a switch and get it back going again. It kind of lumbered along to get back to speed. And at the same time, we were injecting a lot of cash into the system and stimulus. So a lot of extra stimulus went into the system. And of course, that doesn't get deployed right away. Some of those stimulus checks do. But when you're stimulating specific industries or businesses, that takes longer, like those PPP loans or the second round of PPP. And as that money starts working its way through the system, that's when we started to see some inflationary pressures. Then you had the supply chains being disrupted by changes in COVID requirements and people getting sick. And so you have this spike in demand. At the same time, you don't have a spike in supply, which just very basic economics. When you have higher demand for the same amount of supply, the price has to go up.
Interesting. Can you tell me a little bit about how lenders and borrowers benefit or suffer from inflation?
Sure. So inflation is really one of the most regressive taxes, because it impacts those in the lower income areas of our economy the most. Those prices go up very quickly, and oftentimes the capacity to earn a living doesn't go up as quickly or as sharply. And so it's especially for folks on fixed incomes like Social Security, it can be very difficult. The borrowers, so if you're borrowing money during an inflationary time period, you may have lucked into a good situation. And the way that governments do this, so governments borrow money all the time. We're constantly issuing new treasury bonds here in the United States, and we're borrowing money. One way to reduce your debt burden is to inflate your way out, meaning you just keep inflating and inflating and inflating the economy, and that $1,000 worth of bonds that you sold 10 years ago really doesn't look that bad because you've had so much inflation, and you can inflate your way out of it. So for borrowers, it can be a good tool. For lenders, so people who buy bonds or are lending out money, it can become a struggle. And that's the reason for that is when you're borrowing money, you're borrowing it at a fixed rate for a fixed amount of time, typically. And with a good example would be a mortgage. So if you have a mortgage, maybe it's 3% over 30 years. Well, if interest rates go up and they keep hiking rates, the short-term interest rate could eventually be higher than that. It could be 4, 5, 6%, which would push those interest rates higher out there for people who are trying to borrow now. So you may be in a great situation with a low interest rate while new borrowers are really going to struggle. So that can help put a cap on housing prices because not as many people will qualify because it's more expensive to borrow. Inflation also impacts bonds in another way, in that if you buy a bond today and say it's 1% yield, and they hike interest rates up to 2%, and now the market is demanding 2% yield. Well, the price of bonds and the yield on the bond are inversely correlated, meaning if interest rates go up and bond yields go up with them, then the price of your bond goes down. So you may actually lose money on bonds that you own because interest rates are going up. And that actually happened last year, the calendar year 2021. People who had the US aggregate bond index as a holding in their portfolio actually had a loss of over 1%, including when you include their dividend and interest payments. And that's because interest rates went up throughout the year and you actually had a loss on your bonds, which is fairly uncommon.
So this is kind of a follow-up question to that. What does the bond market tell us about what, consumers, about what most Americans think about the future of inflation in the United States?
Well, lately the bond market's been signaling, especially in the last 2 weeks, that it's been signaling that interest rates are going up. It's now pricing in the better than 50% probability that we'll have 3 rate hikes next year, effectively saying that the market believes we're going to have 3 rate hikes this year, possibly 4. And if it's 25 basis points, which is 1/4 of 1%, that would mean 0.75% or 1% increase in short-term interest rates this year. And the bond market's been pricing that in. What's been interesting is usually when the stock market goes down in price, the value of bonds goes up. But in early January here, we've had them moving together where stock prices have been trailing down here recently. At the same time, interest rates are going up because of inflation expectations, meaning the value of bonds are going down at the same time as the value of stocks. So it's been a kind of a perfect storm here of late.
Yeah, that sounds kind of frightening. So tell us, give us your kind of summary. What does the average investor need to know about inflation, and how should this affect the decisions that we're making?
The bond market is likely going to be more volatile, meaning it's going to bounce around more and the potential for loss a bit more this year as the Federal Reserve discusses hiking rates and ultimately likely will increase interest rates. As interest rates go up, bonds become more attractive. So there's a point at which a bond becomes more attractive than a stock to an investor, and bonds are known to be less risky than stocks. And so at some point, more people will migrate away from stocks into fixed income bonds because of the lower risk and higher yield that they're giving them now. So it'll likely slow the stock market appreciation, at least that's what it's done historically, and move people more into bonds as they become more and more attractive to buyers. For current bondholders, it's going to be painful as they weather this storm of higher interest rates and maybe another year of a negative return on their bond portfolio. But really the bonds are there for most folks for the protection and safety. So just weighing your risks and looking outside of traditional stocks and bonds for other types of ways to take risks is another opportunity for investors to try to diversify away from some of this inflation risk.
Wonderful. Thank you so much, David. I appreciate your time.
Oh, it's my pleasure. Thanks for having me.